In this presentation, we will discuss the effect of a tax refund from the state on federal income taxes. In other words, if we get a tax refund from the state, do we have to include it in gross income for federal income taxes? Do we have to pay federal income taxes on the refund from the state? For more accounting information and accounting courses, visit our website at accountinginstruction.info. We have the answer that we often have within taxes. It depends. The amount of the state or local tax refund is taxable in the current year if, in the prior year, the refund was deducted as an itemized deduction. This does make sense if we think about it, but it takes a little bit of thinking on terms of the timing differences that are happening when we think about the tax deductions. So with the state taxes, it's really kind of confusing to have the state taxes be deductible on the federal return. So that's really the confusing component of this. The state and local taxes, we typically get a deduction for the state and local taxes. For example, if we're in a state that has income tax, then we often get to deduct that income tax on our federal tax return. However, the income tax that we get to deduct is an itemized deduction. So that means we're only getting a benefit from that deduction if we itemize. But we also know that if we overpay the state tax, so in year one, if we overpaid the state tax, then we would get a deduction higher than the amount that we actually paid in taxes because we're going to get a refund. So in other words, if we said that we claimed state tax payments of $10,000 that we claim in year one, and we get a deduction for the federal income taxes for the $10,000, and then the state gives us back $3,000, well, then the IRS is saying, well, you in year two, you got $3,000 back, which you deducted in year one. You got the benefit from the deduction in year one. Now you got the money back. You didn't really pay $10,000, which you deducted. So the $3,000 that you're getting back, that's okay. You just report it as income in the current time period. So that's what happens, and that makes sense, except for the fact that we may not get the benefit of itemizing the deduction. So now we've got to think about, did we get a refund in the prior year? We can know that pretty easily because the state will typically tell us with a 1099-G that we got a refund. But that's not the end of the story now, because now we've got to think, did we get a benefit from the state tax payment in the prior year through getting an itemized deduction? And it's a lot easier to know that if we did the return in the prior year and or if we have the tax software from the prior year that'll roll that forward for us. So that's the determination we need to know in order to know whether or not we included an income and pay taxes on it. And even that's a little bit confusing because even if we itemize, we have to consider, did we get a benefit from the state taxes within the itemized deduction? So the taxable amount would be the lesser of the amount received, so the amount received or the amount deducted on Schedule A. And you would think that that would be the case, right? So if whatever we deducted on the Schedule A, we would, if we got less of a deduction on the Schedule A in year one than the refund we got from it, then you would think we would only have to include the amount that we got a benefit from as a deduction. Otherwise, the amount received, usually the amount received will be equal to the amount that we got to deduct if we're itemizing. But that may not be the case, and it might also be the case that the amount that the itemized deduction exceeds the standard deduction is less than the amount we received. In other words, what if we only itemized by like a couple dollars? The standard deduction was really close to the itemized deduction. So we itemized, but we really only got a benefit over the standard deduction of a few dollars. Well, in that scenario, the state taxes didn't give us we didn't really get to deduct the whole amount because we weren't itemizing fully. So when we really think about it, this general rule kind of makes sense. If we got a benefit in year one from deducting the state taxes, then we should include it in year two, the refund, the overpayment in year two. But when we actually apply that, we have to then consider what actually happened. And usually, if we itemized, then we were able to write off all the state taxes and then would have to include it in income. But even then, there's a couple kind of exceptions in terms of how much benefit did we actually get, even if we itemized. The state taxes will typically be reported to us by the state with a 1099-G. So we'll have that will be clear. We'll have that information. And hopefully if we have software that kind of rolled over from the prior year, if it's a returning client or our returning return, and we entered it in the prior year, we can enter it into the system, and the system will basically generate that for us, and we can say, why did it not include it or include it? And we can then work backwards to see how this rule is being applied. If it's the first year that we're entering this into our system, then we're going to have to go back to the prior year tax return and see what happened with it. For more accounting information and accounting courses, visit our website at accountinginstruction.info.